All right. So for the November 2017 paper, question 1, list the 3 withdrawals from the circular flow of income and spending. When we look at the flow of income and spending, we've got production, income, and spending. And we said that all 3 of those variables were equal to each other and they all occurred at the same time. Okay, so spending, production, income all occurs at the same time. All right. There are, however, leakages from the system and injections into the system. And you've got to be able to name all of those leakages and injections. All right. So the 3 withdrawals that we look at when we talk about the circular flow, there are taxes. All right. Now, tax would obviously decrease the amount of money that you spend on goods and services. So it is a leakage. The next one, savings. And finally, imports. So wherever we have money exiting that circular flow, it is the withdrawal. Okay, now what you need to remember as well for your Cartesian graph is that savings is equal to investment. So savings is the leakage and investment is the injection, and they are equal to each other. All right. So if they give you the change in the Cartesian graph, they say the investment increases by 100. They ask you what is the value of savings. It is equal to investment, so it would also be equal to 100. Price stability is one macroeconomic objective of South Africa. List the other 4 objectives. You have to know the 5 macroeconomic objectives of South Africa. All right, now when we talk about price stability, we are talking about inflation. And you need to know a few things about inflation. The bracket between 3 and 6%, how it is targeted by the monetary policy, which is the Reserve Bank's policy, interest rates, money supply, all the rest of that. Okay. So, price stability. The other one that we look at is economic growth. Now, when we talk about economic growth, we are talking about the change in real GDP. Okay. Now, why we look at the change in real GDP as opposed to the change in nominal GDP is because of the effect of inflation. All right. Nominal GDP takes into account, or rather has inflation effects within it. Okay. Real GDP takes inflation into account and actually subtracts the inflation from your GDP. So when we look at the change in real GDP, we're looking at proper economic growth. Okay. The third one, balance of payment stability. Now, balance of payment stability, remember the balance of payments is the account that records the transactions of South Africa with the rest of the world. Okay? And you need to know the different sub-accounts within your balance of payments. Okay, current account, capital transfer account, financial account. Equitable distribution of income. Right, now how did we measure the distribution of income? We had a couple of different methods, but the main one is the Lorenz curve. Okay, you need to know how to draw your Lorenz curve and you need to explain it. Okay, they won't ever ask you to calculate your Gini coefficient, but they will ask you how to calculate it. And remember, we use the Lorenz curve to calculate our Gini coefficient. Okay, very popular questions. And then the last one, full employment. All right? Or as close to full employment as possible. That you would need to know how to calculate your unemployment rates. Now, your rate of unemployment is calculated as your unemployed divided by your labor force, or your economically active population, or your unemployed plus your employed. Those are all the same things. Okay. Explain the difference between gross domestic product and gross national income. Okay. So when we look at GDP, it's obviously called gross domestic product. Okay. So we are looking at the production product all products made in South Africa, right, by foreigners, or by citizens and foreigners. So GDP does not care whether the product is produced by South African citizens or foreigners living and working in South Africa. It just totals all the production. Okay. Now, gross national income, on the other hand, measures the income earned by South African citizens living in South Africa or abroad. So gross national income, on the other hand, is more concerned with how much money South African citizens are earning, whether they live in South Africa or not. Okay. Does that make sense? In the table below, provide three differences between consumer price index and the producer price index. Remember the CPR and the PPR. We use the change in CPR to calculate our inflation rate. And the equation that you need to remember to calculate your change in any variable, percentage change in any variable, is the new minus the old over the old times 100 equals your percentage change. So if they ask you to calculate inflation rate, you use your CPR, you substitute them into that equation, and you calculate your rate of inflation. They can ask you for CPR and or PPR. All right. So the differences between the two: consumer price index, right? Consumer. Obviously, the CPR is the cost of living. The CPR indicates the cost of living for individuals. Okay. Consumption. Consumers purchase the goods for end use. All right. Producer price index, on the other hand, shows the cost of production. So the producer price index and the inflation rate calculated using the PPR measures the change in the cost of production. All right. Number two, now because CPR is obviously your final products bought by the end users, consumers. When you buy products from the supermarkets, you obviously pay VAT. Okay? So CPR includes VAT. However, PPR does not include VAT because they are not final products. They are sold off to end users. Right. And then finally, the CPR includes both goods and services. And the producer price index is goods only. All right. Use examples to explain the difference between contractionary fiscal and expansionary fiscal policies. All right. So firstly, what you need to know about this is your fiscal policy is your government's policy. All right. Remember, we also look at the monetary policy, but that is the policy of the South African Reserve Bank. Okay. So fiscal policy is your government's policy, and it is made up of government expenditure and taxation. All right. Now, if the government were to run an expansionary fiscal policy, it could be an increase in government expenditure. It could be a decrease in tax, or it could be both of those. All right. The government can use both government expenditure and taxation, or only one of those variables. All right. A contractionary fiscal policy, on the other hand, is the opposite. Contractionary fiscal policy is a decrease in government expenditure, an increase in tax, or again, both of those, all right, at the same time. Now, an expansionary fiscal policy is used to stimulate the economy, all right? Expansionary fiscal policy is used to stimulate the economy to boost production, all right? Whereas a contractionary fiscal policy is used to cool the economy down, all right? Now, why would the government want to slow economic growth? To prevent inflation. Okay, why would they want to cool the economy down? To combat inflation. Okay. Consider the following statement and answer the questions. In 2007, the US economy entered into the worst recession since the Great Depression. Real GDP declined by 5.1%. Unemployment rate rose from 4.4 to 10.1. Use the ADAS framework to explain how monetary policy can be used to address this problem. All right, so you obviously need to know how to draw your ADAS graph. It looks the same as your supply and demand curves. The only difference is you've got price level on your y-axis and you've got output and income on your x-axis. Right. So whatever it is, P0, Y0, they're just placeholders. They're more interested in how you move the graph. Okay. Now, firstly, what you need to remember is that your fiscal policy and your monetary policy are what we call demand management policies. They affect the economy from the demand side. Okay. Which means obviously if you've got an aggregate supply curve and an aggregate demand curve, the monetary policy and the fiscal policy are going to only affect your aggregate demand curve. Okay, so if they would like to boost employment, they would like to boost economic growth, what they can do is they can run expansionary fiscal or expansionary monetary policies. Now, an expansionary fiscal monetary policy would shift your AD curve to the right. Okay. Remember your point of origin where the two axes meet. So anything further away from that point is increasing. If you shift the curves to the right, the variables are increasing. Okay. Now what effect will that have? You need to explain to the examiner that there will be both an increase in output and income from Y0 to Y1, but there will also be an increase in the price level from P0 to P1. Now what is the price level? It's the general price level, okay? So when we have an increase in the general price level, what is that? Inflation, okay? Right, so you've drawn the effect on the graph, and that addresses the problem of declining output and rising unemployment. As we increase our economic activity from Y0 to Y1, what's going to happen? Okay, we're going to be producing more goods and services, but remember our circular flow: production, income, spending. As production increased, so did income. Why? Because we employ people to produce those goods and services. All right, so what is happening there between Y0 and Y1? Remember I told you everything in this module relates to the circular flow. As we increase our production from Y0 to Y1, production is increasing, which means that income will increase. Why? Because we employ more people to produce more goods and services, and we pay them more, which means they are going to go out and spend that money on more goods and services, which drives up spending, which obviously spending is demand for goods and services. So as spending increases, demand increases and further increases production. And this is how we can boost the economy. All right, we stimulate the economy. All right, does that make sense? For your explanation, all right, so anything that I've just said there would work. I'm just going to give you quick answers here. Your monetary policy is a demand management policy. Now, if you want to boost the economy, you need to run an expansionary monetary policy. Expansionary monetary policy is a decrease in the interest rates or an increase in the money supply. So when we looked at the fiscal policy, I said an increase in government expenditure and or a decrease in tax, all right, because they can do both of them, or they can only do one of them, all right? So the government can use those two variables in any which way. However, when we look at the monetary policy, the monetary authorities can use only one of those variables, interest rates or money supply, okay? So if we use the interest rates, what is the chain of events? A decrease in interest rate boosts investment spending. So this is from your monetary transmission mechanism. A decrease in interest rate increases investment spending. Now you've got to think of your Cartesian graph. When we increase investment spending, we shift the demand curve upwards. Okay? And how does that affect your output and income? It increases your output and income. So that increases, and output and income is GDP. So our GDP would increase, and our employment would increase because we need to employ more people to produce those goods and services. So capital N is employment, or you could say a decrease in small u. Small u is unemployment. Okay. And that obviously means the same thing. Increase in employment is the same as a decrease in unemployment. Using the following diagram, show what will happen to the exchange rates between the rand and the dollar if South African tourists in the United States increases. Now, what you need to remember is when you are drawing your foreign exchange market, you are always drawing the supply and demand curves for the foreign currency. You are not drawing the supply and demand curves for the rand. Okay. So, it looks exactly the same as your supply and demand curve. Now, on your normal supply and demand curve, you've got quantity on your x-axis, which is exactly the same in this case. And on your normal supply and demand curve, you've got price on your y-axis, okay? In this case, you are still dealing with the price, but you're dealing with the price of $1. And the price of $1 is your exchange rate. So instead of putting price, you put your rand-dollar exchange rate, but it is the same thing. It is the price of a dollar, okay? So again, you can just use your placeholders, Q0, P0. Now, if you travel to America, Americans do not want your rands, okay? We would love their dollars. They don't want our rands. So when you travel to the States, typically you go to the bank, you could give them some rand, and they would give you some dollars, okay? What's essentially happened behind the scenes there is that on the international exchange of foreign currencies, okay, rand is being supplied to the foreign exchange by your bank, and they are buying dollars on your behalf, which they give you when you go overseas. All right. So basically what I'm saying is when you travel to America and spend dollars, the demand for dollars increases on the foreign exchange market. Okay. Now to show that on your graph, what is an increase? You move further away from the point of origin. So we're going to shift the demand curve to the right. Now, when you shift the demand curve to the right, you move to a new point of equilibrium. All right, and look where our new point of equilibrium is. The quantity of dollars traded has increased, okay? And look at the price. Price has also increased. So now what this means is that the price, the rand price of the dollar has increased, okay? Which is equivalent to a depreciation of the rand. So when you move up the y-axis on your foreign exchange market, the rand is depreciating, okay? It did cost you, let's say for example, this was 10 rand. Previously it cost you 10 rand for a dollar, but now it is costing you 11 rand a dollar. Right, so the dollar is more expensive in rand terms. The rand has depreciated against the dollar. And obviously the reverse, the dollar has appreciated against the rand. Okay. Don't use the words increase and decrease when you're talking about your change in exchange rates. It's appreciate or depreciate. Okay. Okay, for your explanation, I'll give you 1 minute there. All right, so you could say tourists increase to America. This increases the demand for dollars, which increases the price of dollars, which is an appreciation of the dollar against the rand, and therefore it is a depreciation of the rand to dollar. All right, but anything else that I said there, you can throw that in there as well. Explain why the simple Cartesian multiplier tends to be bigger than the multiplier derived after the introduction of the government sector. Firstly, what you need to know is that your simple Cartesian graph or your simple Cartesian multiplier, remember, it includes only consumption and investment. That is your simple Cartesian graph. Right. Now, what they're saying here is that the multiplier is larger in your simple Cartesian graph than it is in your Cartesian graph with a government sector. Okay. Now, the reason for that is because of your tax rate. Okay. So when we include the government sector, we don't only include government expenditure, but also taxation. Okay. Now, I'm going to use, okay, let me give you the answer that I've made up here, and then I'm going to use the equations as well to show you. So when we introduce the government sector, we include tax. Now, what is tax? We said it was a leakage from the circular flow. This reduces the size of the multiplier. And why does it reduce the size of the multiplier? Because we are diverting expenditure away from goods and services and towards tax. Okay. So therefore, the size of the multiplier is reduced. Okay. Now, if you were to use your calculations to explain this, when we calculate the multiplier in a simple Cartesian graph, 1 over 1 minus C. Okay? When we calculate the multiplier including a government sector, it's 1 over 1 minus C multiplied by 1 minus T. Okay. So now obviously the tax rate would be something. It would be a certain percentage. Let's assume that it is 20%. Okay? We are subtracting 0.2 from 1, which means we are multiplying the marginal propensity to consume by 0 point something. right? Which reduces the size of that. 1 minus that increases your denominator and therefore decreases your multiplier overall. Right. Now, when I give you these answers, I don't actually like to give you the answers like I've done here because there is no set answer here. You just got to use your theory and you can apply it. There's not only one correct answer here. As long as you just explain your point of view and you get it across, you will get the marks. Okay. So don't learn this as a model answer. You need to understand this work. This is an understanding subject. Okay. And it all relates back to your circular flow, your Cartesian graph, your ADAS, whatever the case is. All right. Suppose you are given the following information for the South African economy. Answer the questions that follow. Calculate the marginal propensity to consume and the marginal propensity to save. All right. So now what is your marginal propensity to consume? Your MPC is the change in your expenditure when your income changes. Okay? So if my income increases by 1 rand, how much am I going to spend of that 1 rand versus how much am I going to save of that 1 rand? Okay. So you could have used any figures in the table here to calculate that, but the easiest one that I found was from 1,300 to 1,400, it is a 100 increase in income. And what you will see here is an 80 increase in expenditure. So when I increase my income by 100 rand, my expenditure has increased by 80 rand. Okay, which obviously means I must have done something with the last 20 rand. I saved it. Okay, so the reason I use that, percentages. Okay, now that would equate to 80%. And what do we know when we are looking at our MPC? We don't use the percentage, we use the decimal. So divide that and we get an answer of MPC is equal to 0.8. Now, how do we calculate our marginal propensity to save? MPC plus MPS is equal to 1. And we know that our MPC is 0.8 plus our MPS is equal to 1. Therefore, MPS 1 minus 0.8, which means that our MPS is equal to 0.2. Right. Calculate the multiplier. How do we calculate our multiplier? Multiplier is equal to 1 over 1 minus the MPC or small c. So in your exam, they mean the same thing. MPC and small c is the same thing. Equals 1 over 1 minus 0.8, 1 divided by 0.2, which equals 5. Indicate on the table the value of savings at income levels 1,300 and 1,500. So if you look at that, pretty easily, you see here when you earn 1,300, you spend 1,300, which means that there's no money left over to save. Okay? When you earn 1,500, you spend 1,460, which means you save 40. Okay. Not a trick question, it is that easy. Explain how a 1% decrease in the repo rate would affect the general price level within the economy. All right. Now, first, you need to know that the repo rate is the rate of interest that the South African Reserve Bank charges the commercial banks. Okay. The commercial banks then add on 3.5% and charge us the prime rate. Okay. So if the repo were to decrease, it means that the prime rate decreases. And what happens when the prime rate decreases? The cost of funds decreases. The opportunity cost of borrowing money decreases, and therefore people are going to borrow more. Borrowing, or another way of saying borrowing, you can say money demand, will increase. Okay? What do we do when we borrow more money? We spend more money. All right? And what happens when we spend more money? Think of your supply and demand curve. The demand curve will shift to the right. Okay? And as we shift the demand curve to the right, what happens to quantity and price? Quantity increases and prices increase. All right. Write a paragraph in which you explain two supply side and demand side policies that can be used to reduce the unemployment. Okay? So I'm just going to list them for you here. I'm going to list 3 of each of them. You can sort of put it into your own wording. There's a nice chapter on it in your notes that you need to just read over. Okay? So firstly, your supply side. How would we reduce the unemployment from the supply side? You could limit your population growth. You can control immigration. So you prevent people from coming into the country. You can improve education. And from your demand side, you can increase your labor intensity of production. Remember the 2 different production techniques that we get? We get labor intensive and capital intensive production. Labor intensive is when you use more labor than capital to produce your product. Capital intensive is when you use more capital than labor to produce your product. Okay? So obviously, if we increase labor intensive production, we're going to employ more people and less capital. Okay. Demand side, what else? Remember our fiscal and monetary policies, they are called demand management policies. And if we shift those to the right, what happened to our outputs and income? Okay, think of your ADAS graph. When we shifted the AD curve to the right, output and income increased. What did we need to do? Employ more people to produce that output. So your fiscal policy expansion or your monetary policy expansion all right, and for your fiscal policy, it's either an increase in government expenditure or a decrease in tax, or both of those. And for your monetary policy, it would be a reduction in the interest rate, or it would be an increase in the money supply. Or you could increase exports. So we increase exports, we increase the demand for our goods and services, and obviously we need to employ more people to produce those goods and services. Your cost push inflation and demand pull inflation. Name any 2 policies that can be used to combat both of those. All right. For your cost push inflation, is from the supply side of the economy. So any factor that affects your supply curve, your aggregate supply curve, will cause your cost push inflation. The demand side is anything that affects your aggregate demand. Right, so for the first one, we can keep wages under control or keep wage increases, should we say, under control. We can increase productivity. Now, what happens when we increase productivity? We shift the aggregate supply curve to the right. And what happens? Think about the price and output. The price level decreases when your aggregate supply curve shifts to the right. Okay. Your demand pull inflation, it is monetary policy and fiscal policy. Right. Define the following concepts. Economic growth. I've done this already. We said it was the change in real GDP. It is the year-on-year increase. Unrecorded activity. We're talking about production that is unrecorded or not counted towards our GDP. The business cycle. Remember, economic growth does not occur smoothly. It follows a series of upswings and downswings, which we call the business cycle. All right. Capital deepening is when you increase the amount of capital per worker. And finally, domestic demand. Total demand for goods and services by the domestic market. Any questions? Right, so multiple choice. Number one, the flow of income and spending is usually, now when we look at the flow of income and spending, what is income and spending? It is money, okay? So it's obviously a monetary flow. It's not going to be goods. It's not going to be services. And when you walk into a store and you purchase something, you give them the money and they give you the products. The product and money are moving in the opposite directions. So it would be option 4. Number 2, the factor market describes a market in which, now obviously because we're talking about the factor market is where the factors of production are bought and sold. but who purchases them and who sells them? You need to remember that households sell their factors of production on the factor market to firms. Firms are buyers on the factor market. The labor market is an example of a factor market. Remember your 5 factors of production: land, labor, capital, entrepreneurship, and technology. Okay. Which one of the following provides a definition of the opportunity cost of holding money? Interest that could have been earned on bonds. Remember, when we look at the demand for money, we assume that there's only 2 assets, money and bonds. You either hold your wealth in money or bonds. And we said that bonds earn an interest, money does not earn an interest. Okay. So the opportunity cost of holding money is the interest that you do not earn because you did not use that money to purchase a bond. Okay. Obviously, you all knew that already because you've all studied. The most comprehensive measure of money is equal to, so you got 3 different measures of money: M1, M2, and M3. Now, M1 is your most narrow definition or measure of money. M2 includes slightly more. M3 includes the most, all of it. It is the most comprehensive measure of money. Okay. The equation for M3 is equal to M2 plus all long-term deposits. So that is your most comprehensive measure of money. If the inflation rate were above the target, it would be appropriate for the Reserve Bank to do what? Okay, so if the inflation rate is above the target, they need to use contractionary monetary policy. And what is contractionary monetary policy? An increase in the interest rates or a decrease in the money supply. All right? Now, if the central bank, here's our economy, and here's the central bank. Remember, they are 2 separate entities. If the central bank were to buy government bonds, okay, what would happen? They would give the economy a bunch of money and they would take out the bonds. Okay? So that would definitely not be what they wanted to do. Okay? Lower the interest rates. If they lower the interest rates, borrowing will increase, spending will increase, further driving up the prices of goods and services. They don't want to do that. Increase the quantity of money. Okay, that relates back to the first one. If the money supply increases, people will borrow more money, they will spend more money and drive up the price level. So they should do none of those. Tax rate is proportional. Now, a proportional tax rate is when the percentage remains the same regardless of the amount that you earn. So company tax in South Africa is proportional, 28% regardless of how much your company earns. Okay? The ratio of tax paid to income remains the same whether the taxable income increases or decreases. Okay. Which one of the following statements regarding taxes is correct? You need to know your 3 criteria for a good tax system. All right. They should be neutral. Taxes which distort relative prices are not neutral. Right. Number 9. Which of the following could be expected should government plan to apply an expansionary fiscal policy? You should know that by now. An increase in the budget deficit. What is a budget deficit? A budget deficit is when government expenditure is greater than taxation. So if they are increasing the budget deficit, it means that they are further increasing government expenditure and or decreasing tax, which is exactly what they need to do for your expansionary fiscal policy. What is the opportunity cost of producing a car in country A? Remember, to calculate your opportunity cost, you need to divide one of the products by the other product and come up with a ratio. Okay. So when country A decides to produce one car, what are they giving up? They could either produce 1,000 beds or they can produce 500 cars. So to calculate, obviously 1,000 divided by 500 gives us 2. When country A decides to produce one car, they need to give up 2 beds to produce that one car. To benefit from trade, country B should specialize in the production of what? So remember, to calculate which product they should specialize in, it is not the absolute advantage that counts. It is relative or comparative advantage. It is the opportunity cost. Now, because we divided beds by cars, we need to divide beds by cars for country B as well. So 4,800 divided by 1,200 gives us 4. Because these numbers are different, it means that there is a basis for trade within these two countries. If they were both equal to 2, it is what we call equal advantage, and there is no basis for trade. In this case, obviously, they're different, so there is a basis for trade. Now, what this means is that when country B decides to produce one car, they need to give up 4 beds. Whereas what we said in country A, when country A was to produce one car, they only needed to give up 2 beds. So country A is more efficient at producing cars, and therefore country B is more efficient at producing beds. Why? Because when country B decides to produce one bed, they only have to give up 1/4, okay, of a car. Whereas when country A, they need to give up half. Okay. Based on the diagram below, which illustrates the foreign exchange market, the shift in the supply curve from S to S1 is due to what? So firstly, what is the shift from S to S1? It is an increase in the supply of whatever the foreign currency is, dollars. Okay. So what would increase the supply of foreign currency into South Africa? Number one, more South African firms purchasing capital goods from the United States? No, the demand for dollars would have increased in that case. An increase in the gold price in the South African market? That would be it. Why? Americans need to swap more dollars for the same amount of gold, so we get a higher supply of dollars. (13) A depreciation of the rand will lead to a decrease in what? So when the rand depreciates against the dollar, it becomes more expensive to buy $1. Therefore, it becomes more expensive to buy dollar-denominated assets or products. So what happens is imports decrease when the rand depreciates and exports increase. Okay? The price of South African products sold in the US will decrease because Jimmy the American has to swap less dollars for the same amount of rand to purchase the same amount of goods and services from South Africa. Which of the following is not a final good? It would be leather bought by Toyota because it is used in the production of other goods. So remember, this would be your intermediate products. Intermediate products are used in the production of other products. Capital products or capital goods are used to produce other products. So the capital good in the Toyota factory would have been the welding machine. The welding machine is used to produce cars for Toyota, whereas leather is used in the production of a car. Three ways of calculating GDP: income, expenditure, and production methods. And obviously, whether you calculate GDP according to the income, expenditure, or production method, you should get the same answer. Okay. The CPI was 109.7 in 2014, 114.7 in 2015. What is the inflation rate? You substitute your values into your new minus the old over the old times 100 equation. In this case, the new is 114. And you should get an answer of 4.55, which you round off to 4.6. All right. Number 17. Which one of the following statements is true? Where do you recognize this? A, equal to, greater than, or less than Y. That is from your Cartesian graph. Aggregate demand, output, and income. Okay? It would be 2. When demand is less than supply, the level of production... When demand is greater than supply, it means that the level of production and income will increase to catch up to demand. All right. Number 18, in the Cartesian model, the consumption schedule shows what? It shows an increase in income, increases consumption, but by an amount smaller than the increase in income. Why? Because our MPC is a value less than 1 and greater than 0. MPC is between 0 and 1, and you multiply the change in income by your MPC, which is a value between 0 and 1, to calculate how your consumption will increase, how much your consumption will increase by. Given an autonomous consumption of 100 Rand and the marginal propensity to save of 0.35, what is your consumption function? Remember, your consumption function, total consumption, is equal to C0, which is autonomous consumption, plus small cy, and small c is your MPC. How do we calculate that? MPC plus MPS is equal to 1. Our MPS is 0.35, which means that our MPC is equal to 0.65. All right? You've got your autonomous consumption there. It is a positive. Remember, autonomous consumption is positive even when income is 0. So it's going to be one of the two positive ones, and obviously we've substituted 0.65 into our consumption function. If taxes decrease, the equilibrium level of income will increase. Okay. You need to know the factors that would affect your slope of your aggregate demand function. The MPC, the MPI, which is your marginal propensity to import, and the tax rate. Okay. The value of the multiplier increases if the marginal propensity to consume increases. Right. Question 22. There's an error in the paper. Your MPC should be 0.2. Sorry, 0.8. Question 23. Based on the diagram below, which illustrates the ADAS graph, the aggregate demand curve will shift from 81 to 82 if what? So we're moving towards the origin. We are decreasing aggregate demand, contractionary fiscal and monetary policies. Wage decrease? No, that would have affected our supply curve. Government expenditure increases? No, that would have shifted the AD curve right. Price level increases? No. Because we've got price level on our y-axis, when we increase or decrease price level, we would have moved along the curves. We would not shift the curves. So none of the above. If income is below the full employment level, what would be the result of a contractionary monetary policy? If we run a contractionary monetary policy, we decrease total production and decrease the price level. Increased unemployment benefits and less incentive to work can be illustrated by, now, employment, or rather labor, affects our aggregate supply curve. It is a supply side factor. So think about it. When the amount of laborers decrease, it means that there are less laborers working, producing goods and services. It means that the aggregate supply curve would shift to the left. Right, you guys need to understand the graphs pretty well so you can imagine all of those movements, or you can actually just draw them on your graph, on your exam, but that will obviously take a lot more time. Okay. Stagflation is a situation in which there is high unemployment with high inflation. This can be illustrated by a leftward shift of your AS curve. So let's just use this. There's my price level P0, Y0. When your aggregate supply curve shifts left, we have a decrease in economic activity as well as an increase in the price level, which is what stagflation is. You also need to know how to draw it on your Phillips curve. Stagflation is when your Phillips curve shifts to the right. Okay. Which of the following will not help the government to lessen stagflation due to cost push inflation? Remember, cost push inflation is from the supply side. We need to use a supply side factor to combat that. And obviously, demand management policies will not combat a supply side factor. If people become unemployed because of a fall in aggregate demand, it is known as cyclical unemployment. You need to know your 4 different types of unemployment. 29. The labor force is made up of the number of people employed plus the number of people that are unemployed. And the number of employed plus unemployed is equal to your labor force or your economically active population. They mean the same thing. And finally, suppose that real GDP for 2015 was 1,000. The rate of economic growth between 2015 and 16 was 5%. What is the real GDP for 2016? 1,000 times 5% equals 50. And that will give you an answer of 1,050.